Welcome, everyone. Welcome to today's webcast, Taking Control of Your Spend, Navigating the eBusiness Suite's Procure-to-Pay Processing Complexities. Before we get started, I'd like to take care of a couple house cleaning items, including reading the following disclaimer. Certain matters reviewed today may represent services that PwC may be prohibited from providing our audit clients. In those instances, the information is being provided to inform you of options that you may want to consider as you evaluate the solution described on today's webcast. Due to the complexity of independence rules, any potential services to our audit clients should be discussed in advance within the context of those independence rules. The information contained in this document is provided as is for general guidance on matters of interest only. PricewaterhouseCoopers is not here and engaged in rendering legal, accounting, tax, or other professional advice or services. Before making any decision or taking any action, you should consult a competent professional advisor. Now for administrative matters. For a better viewing experience, please consider closing all other applications. For better sound quality, consider using headphones. To enlarge slides, click on the bottom right corner of the slide window and drag to the desired size, or click on the green Maximize button on the top right of the slide window. To download today's presentation, click on the Resources widget at the bottom of the screen. Submit questions at any time during the session using the QA window on the left side of your screen. We do intend to try to get to questions at the end of the presentation. However, we have quite a bit of material to cover. If we do not get to questions, rest assured we will be reaching out via email subsequent to the webcast. If you experience technical difficulties during the polling sessions, reply to the question in the QA window and include the poll number. Now for CPE credit. In order to receive your CPE credit, you must stay on for the entire 60-minute program. Respond to all polling questions. At the conclusion of the webcast, click on the CPE widget. It's located on the bottom of your screen, and follow the subsequent prompts to download your certificate. CPE cannot be awarded to phone-only participants or participants who view the on-demand version. All right, let's get started. My name is Steve Sullivan. I'm a partner in the Enterprise Systems Solutions practice within Risk Assurance. I lead up our Oracle competency within ESS. I have over 20 years of experience providing professional services within the Oracle ecosystem that includes helping clients manage risk and establish effective control environments. I'm pleased to introduce Stephen Darcy. He's a director within our Oracle ESS practice with over 13 years of experience working with Oracle, and is currently our national EBS leader and one of our East Coast market leaders. I'm also very pleased to introduce Jon Hansen. He's another director within our Oracle ESS practice with over 9 years of experience with Oracle, and is currently our national ERP diagnostic services leader and one of our West Coast market leaders. So for the agenda, we're going to quickly touch on the risk that we're going to cover in depth. Then we're going to talk specifically about duplicate invoices and expenses, the risks associated with that, invoice matching, invoice processing, Supplier Master, and then we'll conclude and hopefully get to questions. So let's set the stage. I want to briefly touch on a few of the risks that we'll be covering during this webcast. The first is cash leakage. Many of you may be surprised that Oracle EBS is susceptible to cash leakage. We find many examples where cash leakage represents upwards of 1% of the corporate spend running through the Oracle EBS system. Invoice matching. Despite the maturity of many organizations with EBS, the simple concept of matching is far more complex than most organizations can appreciate and in many cases control. Invoice processing. How you've configured your environment and are transacting your invoices can have a direct impact on your bottom line as well as the accuracy of your financials. And then managing the Supplier Master. How you manage and maintain your Supplier Master can lead to significant financial, operational, and vendor performance challenges. So let's make it real. I'd like to ask Jon to share with us some examples of real-life implications associated with some of these risks. Jon?
Yeah, sure. Thanks, Steve. So hi, everyone. I'm Jon. I'm kind of a story kind of a guy, so I wanted to start off with a story that just to highlight as an example the types of risks we're going to be covering today in our session. I want you to sort of have an idea in your mind as to why we're talking about these things. So this example that you see on the screen here, I had a client, and they had typical controls you would see at a lot of companies. They've got a control that they don't want to have any invoices paid twice. It seems obvious, but duplicate invoice payment should be stopped in the system. They had the common control around three-way matching, that invoices should be matched to the purchase order, should be matched to the goods receipt as well. And then segregation of duties. They wanted to make sure users who had access to create suppliers did not also have access to create those invoices for those suppliers. So regular controls, they asked us to come in and use our tools and our technologies to assess, to make sure that their users were actually following these controls and any other things we could find sort of along this line. And our results were very surprising to the client because of some of those complexities Steve sort of alluded to. At the bottom there, you see some of the examples of the things that we found. The client thought that 100% of their invoices were going to be matched, three-way matched. But what we found in reality, there's actually only 3% of their invoices were three-way matched. So the huge expectation gap as to what management thought was happening and what was actually happening. The second one, we found 45 users could create suppliers. They had a very small team of people who were actually supposed to be creating suppliers, just a handful. And to find there were 45 people who could do not only creating suppliers, but also creating invoices was a big problem. So then we took the next step to say, well, did those users create some invoices for the suppliers they created? And we found 2,000 instances where that happened, where the same user who created or updated the supplier was the same person creating the invoice for that very same supplier. Clearly, they were not happy to find this result. Glad to know about it, but not happy that it was happening. And then the last thing we'd found was $5 million of potential duplicate invoice payments. And so the risks around EBS that we're going to talk about today, we want to highlight to you so that you have that in the forefront of your mind as you go through. Maybe these are controls you guys have at your companies. And so we want to educate you on the risk as well as some of the opportunities and solutions that you might be able to think about.
Thanks, Jon. All right, let's dive into our first topic, which is duplicate spend. But before we do that, let's answer our first polling question. Do you currently have technologies in place to help identify or prevent duplicate spend? A, yes. B, no. C, not needed. Oracle eBusiness Suite automatically prevents duplicates. So as we answer that poll, I'd like to ask Stephen a question. Can you share some examples with us of the types of technology being leveraged to mitigate this specific risk at our clients?
Great question, Steve. What we found is that it really ranges across the board depending on the maturity level of the client, at least from what I've seen. When I think across the clients that I've served over the years, a number of solutions come to mind. First off, on the more optimal level, maybe they've purchased a point solution that does this type of thing for them, like an Apex, for example. And naturally, that involves paying licenses for a software. Some of the solutions that we've built as a team for clients have leveraged the Oracle GRC or Advanced Control solution to monitor duplicate spend. In other cases, our clients have hired PwC or similar other firms to come in and build smart transaction analytics to help them leverage continuous monitoring around these types of things. And some rely just on audit recovery firms that they may hire once a year, once every couple of years, which is certainly on the more reactive level. Amazingly, though, the vast majority of the clients that I serve have really no formal procedures or solutions in place to address some of the risks that we're about to talk about in the first section here. So it's across the board.
Thanks, Stephen. Let's see what the results are. 60% answered yes, that a technology exists. Roughly 30% answered no. All right, so let's get started with our first topic. Stephen?
Okay, thanks, Steve. So first off, we're going to explore how organizations can find themselves leaking cash during their invoice processing activities. So let's take a look at two real scenarios that we see happen a lot of times. Scenario one, an AP clerk enters a duplicate invoice that has the exact same invoice number, so ABC 123. The supplier name is exactly the same supplier name as the original invoice, so Supplier A, Inc. The invoice is posted to the exact same operating unit, so in this case, New York. What happens when all of these things occur? The delivered edit and validation checks that sit inside of Oracle recognize immediately that this is a duplicate payment, it's already been entered, and it doesn't allow this second invoice to push through. However, let's take a look at the second scenario. That same clerk receives an invoice that they're not aware has already been entered in the system by one of their colleagues. This time when entering the invoice number, the clerk mistakenly types in ABC 123 in lowercase, or they neglect to include the comma in the supplier name. The clerk may also enter the invoice into a different operating unit. So in this case, instead of posting it into North America, they posted it into the Canada operating unit. Well, all of a sudden, the invoice gets processed, the supplier gets paid twice. So we're going to talk a little bit more about how this happens in reality. How this happens is really quite simple. Suppliers will often not only send an invoice by regular mail in the post, but they may also follow that up with an email, for example, to their contact in their customer's AP department. I know I just did this with one of our clients a couple of weeks ago. We sent it out through our AP department with mail. I followed up with my contact with an attached invoice as well to make sure they received it. But either way, now the AP department has two records of that same invoice. Especially when our clients operate a shared services organization that centrally processes invoices for multiple business units or operating units, maybe even multiple countries at times. This can happen on a regular basis. The sheer volume of invoices coming in to even some of our smaller clients means that manually identifying the receipt of duplicate invoices is extremely difficult to manage. So the invoices end up being processed by different people, and maybe neither person realized that the other clerk is already working on it. Industry experts suggest that we should all recognize that at least 0.03% of their payments are duplicate in nature. So every client is leaking 0.03%. What we've found in all of the analytic projects that we've delivered for our clients is that that percentage is always far greater. But even if we use that conservative industry standard, and you take a client that may have annual spend in the region of $500 million, so a reasonable sized client, on an annual basis, that client is likely leaking over $1.5 million worth of duplicate payments. And again, that would be a pretty conservative estimate. So that's kind of why we're talking about this topic today and sharing this insight with our clients. Let's take it one step further and show you some real examples that we've obviously redacted for purposes of this presentation, but these are real examples that we found at some of our clients. So example number one, on August 19th, Steve Jones receives an invoice. He enters it into the system to the value of $21,000, give or take. The invoice processed successfully. It's the first time it's been entered into the system. However, on August 29th, Mary Judd, who also works at the AP department, receives a similar invoice for the same vendor, same invoice amount, same invoice date. This time, though, she enters the invoice number with some spaces in it as she reads it. Oracle does not know when that happens that it is a duplicate invoice. So it gets processed again, and the vendor gets paid twice. The second example, on July 24th, James Smith, he receives an invoice for $280,000, give or take. And he types that into the system. He processes it fine for a client called Concur Training. However, on September 25th, Jerry Oates, who's also working on that same team, receives a similar invoice, and he goes looking for that vendor in the system. He quickly finds a vendor that closely resembles the name Concur, but it's actually Concur. So Conquer Industries, and he quickly chooses it. The system allows that invoice to be processed even though the invoice number, amount, and date are the same as the original posted by James Smith. Finally, the example that we find that occurs the most, on 6/18, Rhett Jones processes an invoice for Smiths Inc. To the value of just over $461,000, and he posts it to the North America operating unit. He's in an AP shared services organization. The invoice sails through. A couple of hours later, in the same day, Cindy Allen takes the same invoice, but she posts it to the Canada operating unit because that's the address that the vendor just happens to have on their address in the invoice. Now that same invoice has been accepted by Oracle, but in two different operating units, and Oracle cannot detect that it's a duplicate. So there's some real examples of how this actually occurs in the system. Now, we recognize that we have a number of different types of stakeholders on the webcast today. Some folks are from the business and the AP department, some may be from audit or compliance, and others even from IT. Some of you may not be in the system seeing the detailed Oracle screens as to how this happens on a regular basis. So we wanted to quickly share with you what this looks like. This first example is a great example of Oracle working as it's supposed to. The clerk received an error message because all the facets of the invoice equaled. They're processed at the same time. It was identified as a duplicate. Of course, it gets denied. You see the error message pop up on the screen. So how can invoices get paid twice? What happens in reality? Two great examples. We see this happen, and we see it as a reason that clients share with us on a regular basis. It's late in the day. It's month end. Pressure's on to get invoice payments out the door. Clerk goes to enter an invoice, and it gets rejected immediately. They need to get home to their family. Why don't I just add an A to the end of the invoice number? Fantastic. It sails through. Job done. I know this scenario may seem a little bit crazy, but our experience working with clients in this domain, it would actually seem like somebody out there has trained AP clerks that plugging an A in at the end of an invoice number is the thing to do to get your invoice processed. You'd be absolutely amazed how many times we find this occurring during all the projects we delivered for our clients. Obviously, we wish that was different, but certainly something that you should look out for in your own companies. In the second scenario, a similar thing happens. The clerk can't get the invoice to be processed, so they simply change the operating unit they're posting to. It changes from Vision Operations to the Netherlands. The invoice sails through. Okay. Today, so far we focused much of our attention on the conventional invoice processing, but the exact same risk and logic absolutely applies to those clients who are also processing expenses through their Oracle system. Today we're not going to spend any more time on this because it's the exact same rationale, but rest assured the risk of duplicate expenses being paid if you accept both credit or P-card expenses and then also manual expense reports from your employees. It's absolutely another example of how cash can leak out the door, and in any analysis of duplicate spend, it will be wise to include duplicate expenses as part of the assessment. Hopefully the risks are very obvious to most people on the phone. The first is obvious, the cash leakage. We've talked about it a lot. Your organization, put simply, could be losing money, and in some cases, lots of it. In context, just to share another client example, we had one client recently. They asked us to go back over a period of 3 years and identify any duplicate payments that they may have leaked. They were pretty horrified when we found that over $35 million worth of duplicate invoices have been paid over the 3-year period. Outside of the cash leakage, there's the obvious risk of misstating your liabilities, and then just the sheer operational risk of the time that's wasted, first off, processing duplicate invoices, but then also the time that it takes to investigate and recover. It just poses a major inefficiency to operations, and with more proactive monitoring, more proactive and preventative solutions in place, that time could be spent on more valuable tasks. So let's talk a little bit about some of the mitigation strategies that we've helped our clients think through. And the good news is that there's a number of things we've been able to do with our clients to reduce some of the risks that we just talked about. The solutions have included a combination of multiple different strategies as depicted in the slide above. First off, we obviously leverage what the system can do as much as possible. We've talked about what Oracle can and can't do. It's in the same operating unit, all those criteria. It will automatically prevent the invoice from processing. Second, we work with the organization to educate the invoice processing team around the vulnerabilities they have to deal with in Oracle EBS and how these types of things can happen. Call it a retraining, if you will. You'd be amazed how many of our clients, when we talk about this topic, they assume that Oracle just prevents these things from happening. We also make sure that we leverage our own tools to perform a deep dive into our clients' users' access and determining who can perform these transactions in the system. The objective here is to narrow down that user base to only those that really need it, which of course would reduce the overall exposure. Third, this is where we get into the real meat of the solutions, building our clients' smart data analytics to detect and hopefully prevent in a timely manner any potential duplicate invoices that have been entered. We visualize that output so clients can really target their efforts on those vendors that might prove to be best bang for their buck if they're going to go through that recovery process. And our clients then have the ability to run those analytics on a regular basis against their Oracle environment. And finally, for some clients who want to be doubly sure about nailing this down, we've built preventative measures into their system to immediately identify any occurrences. Generally, we've either used Oracle personalization. Some of you may be aware of that. It's essentially configuring but customizing your system. Or we've also used the Oracle Advanced Controls Preventative Controls module, Oracle GRC, to help fulfill this task. When we've done that, some clients have asked to just receive an immediate pop-up notification to tell the clerk, look, this looks like a duplicate. In other cases, they've wanted us to put a hard stop in the system in the form of an automatic hold, so putting the invoice on hold pending further investigation. Here's a quick example of one of our solutions, so visualized analytics that can find those needles in the haystack per se immediately. You'll see in this case that the Corporate Express office supplies vendor seems to be the vendor with most duplicates processed for them. So the client can immediately beeline to that, drill down into the details of that vendor. We include the total value for this client, so $74 million in this case we detected was leaking over a couple of year period. You could also flip, as you see on the left-hand side, and toggle to a different view to show which users, which employees in your system are creating most duplicates, and that will help identify those people that generally need more training or education on the topic. We also help our clients identify duplicates that are most likely to be recoverable. So, for example, those with the same invoice number, date, and amount would represent a very high probability for recovery. Those are the same vendor site, invoice date, invoice amount, but the invoice number is different. It's still worthwhile looking up and investigating, but generally represents a more medium possibility of recovery. So hopefully that helps you understand, how you could potentially leak cash out of your Oracle EBS system via duplicate invoice payments. With that, Steve, I'll pass it back over to you for the next session.
Great. Thanks, Stephen. All right, so let's cover our next topic, which is invoice matching. But before we do that, let's tackle our next polling question. It's polling question number 2. Roughly what percentage of your invoices are three-way matched? A, all invoices must be three-way matched. B, most, 60 to 99. C, less than half. So, John, well, folks answered the second polling question. I was wondering if I could ask you a question in regards to three-way match. Do you feel it's a popular control that's used quite a bit by our clients?
Yeah, I don't think I grew up in the firm doing a lot of audits. Now it's more Oracle consulting and implementations and such. But I don't think I ever saw an Oracle client that didn't have this as a key control. Pretty much every client's going to be having a control around matching, making sure invoices are processed correctly and all the supporting documentation is there. Audit teams place great comfort on this, and they're expecting it to be there. So any client that doesn't have it is kind of getting the runaround with their auditors. So it's very common. We see it all the time. So it's definitely one that likely applies to pretty much every organization who's on the webcast today.
And I guess the only caveat would be that they'd be running purchasing as well, as part of their footprint.
Yep.
All right.
Sure.
Let's see what we have. All right. It looks like most, over 60%, are leveraging three-way match. Great. All right. John, I'm going to hand it over to you.
Yeah, sounds good. So talking about invoice matching in Oracle and talking about how does it work in the system. So this first slide is to help you appreciate you've got the supplier invoice and you're matching that to the goods receipt, the quantities, and then you're matching the supplier invoice price to the purchase order, and then you're matching quantity between both the purchase order and the goods receipt and the invoice. And so that's the matching. When we talk about three-way matching, that's what we're looking for. That's what Oracle is trying to ensure is in the system before a payment goes out the door. Sounds simple, but what we've found is it's not so simple. So let me just kind of walk you through what this slide is trying to help you appreciate. There's a couple site-wide settings that configure your three-way matching. But then every organization or operating unit in Oracle also has its own configuration that can be overridden from what's set at the site level. So every organization, some companies might only have 4 or 5 operating units, but most are going to have somewhere between 50 and 100. It's very common to have quite a few operating units in your system. So you need to configure all of those organizations to have consistent settings, and that's one of the things we see a lot of companies fall down on, is the U.S. might be set up correctly, but maybe Canada not so much, or maybe Belgium not so much, or somebody changed it for one reason and forgot to change it back. And so sometimes there's inconsistency across the world around how they're applying these settings. So then you have your organizations. Let's just assume you get all of those right. Well, now you've got thousands and thousands of suppliers sitting under each of those organizations, and each of those suppliers has their own configurations. And then each of those suppliers have supplier sites underneath them, and they also have their own configurations. Multiply that by the number of inventory items you have, because you also need to configure three-way matching for every individual inventory item. It's not a setting you configure for all of your inventory items at once. It's actually individually applied for every single inventory item. And then lastly, every time somebody creates a purchase order in your system, they have the option of saying, is this a two-way match purchase order or a three-way match purchase order? And so then again, you have another failure point where there's a potential where you might be expecting a certain PO to have a three-way match, but because of what the purchasing accountant or whoever puts it in the system, they may not neglect to select that three-way match option. So if you take your organizations, multiplied by your suppliers, multiplied by your inventory items, multiplied by the thousands of purchase orders, you can start to see how complicated it is to get these configurations right. In my opinion, this is the least automated control in EBS. So few companies get this right. I've never seen a client have all of these configurations set correctly. And we look at these configurations to make sure they are set up because they want to improve. But it's just so hard to get them all right with the screens you have available to you and the monitoring tools that are standard in Oracle. And this just gives you a bit of a perspective around there's different types of configurations. It's not just one configuration, yes or no. There's the invoice match option. There's the match approval level. There's the hold unmatched invoices. So even if you get the matching, you may not actually put the invoice on hold, which means it's not going to be stopped from being paid anyways. You have tolerances. You've got whether people can manually release those, whether a receipt is required. So all these configurations at multiple levels makes it a very complicated setup. So in talking through, I just want to show you some of the screens. As Stephen pointed out previously, some of us may not be as familiar with how that's set up, and so I just wanted you to have an appreciation for all the different places you got to configure this. So this is an example of the site level setting in the payable system setup. So this is going to apply across the board. Here's another site level, and you can default your purchase orders to be two-way matching, three-way matching, or no matching. Then you go down to that organization level. You've got more configurations that will configure for each of your operating units whether or not it's going to require matching. And then again, there's more configurations at the organization level, and I think you get the point. I don't think I need to go through all of these slides to show, but want to make sure you appreciate all the different settings and how many times you got to set them. And most companies are going to have thousands and thousands of inventory items, thousands of suppliers, thousands of purchase orders, and so multiply all of those together, and the chance of you walking away feeling like, all right, our three-way match control is rock solid is very small. So the risks. This is one that I think anybody who's been either dealt with an audit, part of an audit, or has that background can chat these off really quickly. So you're talking about payment of invoices that haven't been received. You might be paying for goods you never actually you don't even have in your company. So that clearly is a problem. Your quantity of goods you received may not match the quantity on the invoice. and you only receive 5, but you're paying for 10. So you're paying more than you need to. Maybe the payment price on the invoice is higher than what you agreed to with your vendor on the purchase order. So you agreed on paying $10 a piece for these items that you bought, and they ended up charging you 12. And if you're not matching to that purchase order, you have no way of knowing that you are out of step with what you were expecting. Clearly, there's compliance risk. The risk of not following your controls that you're asserting to your external auditor, to your management, to your audit committee that you're following, dealing with exceptions and deficiencies that tend to come across with those things. And then just operational risk of just being slow, the inefficiencies of people having to go back and fix things and resolve those issues. So you might be kind of asking yourself, I've got all of these things. I've got so many reasons why matching probably isn't happening. What am I going to do? There's got to be a better way. And we want to talk about those solutions, because that's one of the most important things to take away from this webcast is, what should I be doing? What should I do next? Again, we're kind of following the same thing. There's a scale of maturity. Some companies are better than others, but you've got to start somewhere. So there's some level of system reliance. Clearly, you're going to expect the system to enforce at least the configurations that are set correctly. The second level is your access. You need to be aware of how access is going to impact whether or not things are matched. Access to change those configurations on the supplier level, on the purchase order level. Access to be able to manually release those holds. Access to circumvent this control. Certainly training's involved with that as well. The next layer of maturity is around data analytics. Getting smart with your data, being able to extract all the invoices that you have and figure out, are you really complying with your expectations? Are you really matching? I find a lot of clients will say, well, not all of our invoices need true matching because we have services and we've decided not to enter receipts for services. And that's fine. But what they sometimes forget to realize is that because of that little caveat, they're opening sort of the floodgates, and then all these invoices start going through that same floodgate when they weren't expecting. And so the percentage of invoices not matched is not where they had expected. And then the last is actually preventing these things, stopping these invoices from being paid until they've been properly matched. And as I mentioned, it's usually a combination of all of the above. That's really the most mature way of handling your invoice matching risk and invoice matching controls. This is an example of a dashboard where we tend to take, as I mentioned, we extract all the invoices from our clients' environments and start to visualize those. And let them see what's happening, be able to see how many invoices were processed through three-way matching or two-way matching or no matching. And those no matching are usually the ones we want to focus even more on. And then in the two-way, we want to figure out, is this appropriate? Is there a caveat for services vendors, et cetera? As you see here in this particular client, we found $30 million of invoices in the bottom left corner that did not follow their three-way matching process. That was not what they expected. So, put yourself, say you're in finance or you're the controller or assistant controller. You need visibility into this dashboard so that there's no surprises come audit time. Your teams are following the controls that you're asserting to audit committees, external audit, et cetera, that you're following. Your AP manager, you're going to want to know that your people are doing what you told them to do. They're not getting around that. If your internal audit, your compliance, same thing. IT, you might be interested to know, or you might be responsible for some of the configurations. You might be interested to know if people are circumventing those. So really, getting smart about this data is something that all of us could benefit from doing. Similarly, we create dashboards around configurations. You need to have some sort of a strategy of monitoring those thousands of configurations. You can't spend time going through line by line by line to make sure everything's set up right. So you need a way of quickly seeing where your problems are. You go fix those, you run them again, make sure everything's cleaned up. And that's the strategy behind it. So it's getting smart about leveraging technologies to help you have a more controlled environment. So with that, let me pass it back to Steve for invoice processing.
Hey, John, thanks so much. All right, let's go into the next topic, which is invoice processing. But before we do, let's cover our third polling question. On average, how long would you estimate it takes your company to process an invoice from receipt to payment? A, 0 to 10 days. B, 11 to 20 days. C, over 21 days. D, not sure. So as folks answer this question, Stephen, I was wondering if you could, if what you feel about the invoice hold process. Do you feel that most of our clients think that's a rubber stamp, or do you think they truly spend time investigating prior to releasing?
Yeah, so it really depends. We've seen both ends of the spectrum on this topic. A lot of pressure can kick in for AP departments to try to get invoice released so they can avail of discounts, and especially if the wrong people or too many people have access to release holds, it's very easy to do so, and as a result, improve your KPIs, at which point it kind of becomes closer to, this rubber stamp concept of, okay, we're not really investigating things, we're just getting stuff processed through the system, and obviously that's a greater risk. On the flip side of things, we've seen some companies that spend probably too much time investigating and following up on invoices that are put on hold, so much so that they can't avail of vendor discounts because it's taking them too long to get through the volume of items on hold. So, we'll talk a little bit more about some of those scenarios in the next session, but certainly it's across the board depending on how efficient our clients' processes are.
Great. Thanks, Stephen. So let's look at the results. This is interesting. It looks as if B, which is 11 to 20 days, and D, not sure, is the most popular answer. Appreciate everyone's participation. So let's hand it over to you, Stephen, to cover the next topic.
Okay, thanks. Okay, so let's talk about this other challenge that we see many of our clients face, and basically what it is too many invoices going on hold. So we'll take a scenario, invoice arrived to the AP processing team. Who knows what has happened downstream in the process, so during procurement and receiving, oftentimes we hear our AP department complain that, something's not working downstream, it's making our jobs more difficult. But either way, the clerk enters the invoice and boom, it goes on hold. When your system was originally set up during that initial implementation, decisions were made on how a number of tolerances and configurations were actually plugged into the system. These configurations are absolutely, in this case, determining how your transactions behave in the system. We've seen a lot of this, especially with the recent upgrades to Release 12. When clients, and a lot of clients have decided to just technically upgrade Release 12, they didn't really go back and revisit some of these configurations to make sure they're jiving with current policies and procedures. So depending on how stringent those settings were originally configured to be, even minor differences in the invoice to what the system is expecting will automatically put that invoice on hold. So some of the examples here, if the price is off by 1 penny, or the quantity billed is greater than that on the PO, but same as the receipt even, or even if the exchange rates don't match, your invoice is automatically going on hold. Okay. So again, if you've not seen these settings in your system, they're as simple as the screenshot on this slide. Things like quantity ordered, quantity received tolerances, price tolerances are all in this case, this is from our sandbox, set to a 10% tolerance, meaning that unless the difference is within that 10% range, it will go on hold. So if the price amount is 11%, it's going on hold. Obviously, if it's only a 5% difference, the invoice will continue to process. As I say, this setting that we took from our sandbox probably represents more of a normal or better good practice settings that we see across a lot of our clients. But in a lot of cases, our clients have set those tolerances much more stringently, and as a result, a far greater volume of invoices are going on hold. Another example is the currency match. You'll see here again there's an opportunity to configure that if the currency doesn't match, it'll automatically put a hold on the payment. So again, pushing more volume on hold. So why do we care? Well, as most know, many suppliers offer discounts if you pay your invoice in a timely manner. Jon touched on this a little bit earlier. One of the most common methods that suppliers offer is 210 net 30, which for those who aren't in the know there means a 2% discount if your payment is received within 10 days. Well, naturally, if most of your invoices are immediately going on hold when they come in the door, it becomes harder and harder to get them cleared in a timely enough manner to be able to avail of these discounts. So similar to the first topic, it just means that your company is leaving money on the table, And the resolution could be as simple as taking a fresh look at your tolerances and just making sure that it jives and makes sense with how you want to operate your business and your transactions. So let's talk about the risks involved here. As we just articulated, it could be just leaving money on the table. But when that happens, naturally, that probably brings with it some pressure to make sure that it doesn't happen and that we're availing of these discounts. So would an employee, for example, be motivated to manipulate the invoice to prevent a hold in the first place? Would there be pressure to manually release holds to get those discounts? Looking at access and making sure that you know what's going on there to prevent that risk from occurring is important. Even the pure fact that so much time is required to investigate and fix the holes is an identifier of some operational or inefficiencies out there. A lot of these things can prove to be big challenges for many of our customers. The crazy thing, however, is that so many of our clients aren't even monitoring these things and really have no idea if they're losing money. And it looks like the poll that Steve just covered there would suggest that a lot of the folks on the phone today find themselves in a similar situation where they're probably not availing of their vendor discounts. So let's talk about some of the mitigation opportunities. I think first things first, you rely on the timely manual release of holes. You hopefully have taught your people well enough. It's not ideal though. However, if the volume is especially high coming through your AP department. Second, you've got to make sure your user access is restricted around the abilities to either change the configurations, these tolerances, to either allow or disallow invoices to get pushed through, or to release holes. And if you see activities going on in the system that don't really play with your policies and procedures, and we identify them and help train resources to help make that process more efficient, more optimal. What we've done, we go to step 3, is where we've been helping our clients review and potentially even change those tolerance configurations to levels that continue to enforce policy without pushing higher volumes of invoices on hold. So really getting in and looking at these configurations for our clients, making sure we educate them as to what's going on in the system, and then making a call as to whether or not they need to be fixed. Finally, helping our clients build proper KPI dashboards that will identify those invoices that are close to being at risk for losing the discounts. So analytics on things like how long the invoices are staying on hold, who's releasing the hold, so on and so forth. And really helping our clients proactively and continuously monitor all of these occurrences in the system. In the example on the screen right now, again, it was data we've taken from our client's environment. We've analyzed it, visualized it. We found over 8,000 invoices were on hold for an average of 22 days. So similar to some of the feedback we received in the poll. Obviously this would be a clear indicator to a controller, an AP director, that something is broken somewhere in the AP process and that money is being left on the table. We've been able to show clients the reasons for why these invoices are going on hold, so you can actually start fixing the challenges. Oftentimes that is a configuration, fixing the configuration, making it a little bit more relaxed so you don't get as many invoices going on hold. We've also been able to show clients who is releasing the hold. So aside from who has the access to do it, have they actually been releasing holds, and folks reviewing that list to make sure that only the right people are doing these activities in the system. Steve, with that, I'll pass it back over to you for the next polling question.
Okay, great. Thanks, Stephen. Polling question number 4. Does your company have suppliers that offer you contract terms, including discounts for paying early? A, yes. B, no. C, not sure. So while we wait for folks to answer that polling question, John, I was wondering if you had any practical examples you could share with us related to this risk and the implications associated with it.
Yeah, you bet. So a client comes to mind. We did an assessment of their invoices and how long they were able to, how quickly they could get that through the system. On average, they were taking 30 days to get their invoices through the system. They had a lot of troubles with the purchasing distributions not being set up correctly, with the invoices getting placed on hold for one reason or another. Their tolerances were too stringent. They had a small army whose job it was all day, every day, was to investigate these holds and release them so they could pay their invoices. Needless to say, there was an opportunity to get more efficient. They estimated by making some slight adjustments in their tolerances and in some other areas, and a little bit of training, they'd save about 1,200 resource hours each year. And so, getting the right configurations, as Stephen pointed out, is smart. And we actually did a little research too, and found out that most of their suppliers offered these kind of discounts, 2, 10, net 30, and they were just not taking advantage of them like they could have. So yeah, it's a great point that Stephen brought up, and kind of talking through the impact of these delays.
Great. Thanks, John. All right, so let's look at the result. Looks like most are providing discounts as part of their contract terms, so an important topic. Yeah. All right, let's have John take us through the Supplier Master.
All right, our final topic. So Supplier Master, certainly any company who's using Oracle for payments is going to have a Supplier Master, and a lot of times we don't think a whole lot about it. It's just, these are our suppliers. It sort of is what it is, as they say. So, however, there's a lot of issues and risk involved with just your Supplier Master, what suppliers are in there and how they're maintained. 3 of the risks I want to focus on are, first is the bank account. Your supplier bank accounts are going to be sitting in your Supplier Master. So one, you want to protect those bank accounts. You need to know who has access to those screens. But secondly, that's how you're paying your vendors. I mean, the money's going out of your door and to your suppliers through this bank account in the supplier setup. And so you want to make sure that the correct bank accounts are sitting in your Supplier Master. So that's the first risk. Second is duplicate suppliers. There's a lot of issues caused by having duplicate suppliers. Probably top of the list is the duplicate invoice payments that Stephen was speaking about earlier. You've got to, this is take PwC as an example. PwC might be in your system as a vendor. You also might have PricewaterhouseCoopers. You might also have PricewaterhouseCoopers Canada, or other places as well. And I'm sure other vendors are the exact same. Maybe one person puts the supplier in with the ink at the end, and one puts it without the ink. And so there's that Supplier Master is pretty easy to start getting duplicates over time. And then the third is around the supply chain interruption. How does your Supplier Master affect your ability to deliver to your customers, and how does it actually affect your customer satisfaction and things like that? So let me dive a little bit deeper into each one of those risks and talk specifically about what you should be aware of, and then we'll talk about some solutions or strategies to try to mitigate those risks. So first is on the bank accounts. So you've got thousands of suppliers in your system, and let's think of one example where you've got a supplier that you do a lot of business with, and so you're sending them hundreds of payments every single year. Well, hundreds are going to them, and if I've got access to your Supplier Master, I can adjust the bank account for that same normal approved supplier and put my bank account in it, or maybe my mom's or my grandma's or somebody else. And I just divert one of the payments, and then as soon as that happens, I flip it right back to the way that it was. Well, there's a good chance no one's going to notice that. And your supplier might say, hey, you never paid me for this, and then you'll look and say, okay, well, something must have gone wrong, so we'll issue another payment. So now you paid them twice, and you paid one of your employees. And so that access to the Supplier Master becomes critical. Take a different example where you're just create a fictitious supplier that looks like a legitimate supplier. And then what about that problem being compounded if you then have access to create an invoice, maybe have access to create a receipt, maybe have access to release holds? All those kind of access areas start to come into play around fraud, around compliance, around financial risk, etc. So your access to your Supplier Master is critical, and we alluded to it earlier around how complicated some of the things are in Oracle, and security is no different. I wish we had time to kind of show you the screens that IT has available to them to configure security. It's pretty difficult for them to, with absolute certainty, know that the right people have access to the right things. There's thousands and thousands of menus and sub-menus and functions and sub-functions, and so you really need technology to help you. Technologies, whether it's advanced controls, we've got tools. We run assessments and things like that. Some sort of technology to help uncover that spider web of access that sits in your system. So access to Supplier Master, specifically focusing around bank accounts, is something that definitely needs attention and is worth dedicating some time to. Second risk, I want to talk about is around duplicate suppliers. So a couple impacts or risks that are associated with if you have duplicates. I mentioned duplicate invoice payments. I think that one's pretty clear. Stephen even shared an example of how that happens. How about the top right quadrant there? Supplier changes made to the wrong supplier. So you get a supplier calls and says, hey, we have a new bank account. Here's a new bank account. And somebody goes in and makes that adjustment. Well, if I've got 5 suppliers that all have a similar name, whoever is making that update, she's going to pick one of them. She probably doesn't realize that there's 4 others out there and update the bank account or the address. And so then you go make a payment, and it goes to the wrong place. And then you have to deal with the back and forth and try to fix that. And where did the money go? Did it go somewhere? Did it just kind of end up nowhere? And so trying to deal with that, can cause a lot of inefficiencies as well as potential financial issues. Bottom right quadrant, fraudulent transactions. Clearly, having a vendor that sounds like a regular vendor that you use on a common basis probably isn't going to be questioned. If you're doing a lot of business with a particular company, and if I create a very similar supplier with an ink at the end, you may not question it when it comes through because you do a lot of business with that supplier. And then the bottom left there, inefficiency and maintenance. As I mentioned, just having so many suppliers in your system makes it difficult to try to maintain that master data. The more suppliers you have, the more difficult the maintenance is, especially if there's a lot of duplicates that are sitting in there. The third risk around Supplier Master is around your supply chain interruption. So take this scenario that's on here on the screen. July 1st, you place an order. You create a PO to one of your suppliers to order 1,000 of Part A, 200 of Part B, and 100 of Part C. You need these parts to be able to create your product, which then you're going to send to your customers. Well, you're waiting and waiting and waiting, and all of a sudden thinking, well, who did we actually order this from? So you go talk to your purchasing, and they say, well, we order it from like 15 different people or suppliers. Let me go figure out which one we're waiting on. And then the next question is, well, when did they promise they would give us these goods? What do we have some sort of agreement that they'll deliver it by a certain date? A month goes by and you've got unhappy customers. You got nothing to send them because you're waiting for your suppliers to give you the products that you ordered. Think about your Supplier Master and how you can streamline that. So in an ideal world, what you want is to be able to have suppliers that are giving you, are performing well. They're giving you the goods on the time, on the deadlines that they've set, and it allow you to fulfill your customers' expectations as well. One of the biggest problems that we find is, there's a couple fields. There's a needs by field. There's a promise date field in Oracle when you enter these purchase orders. However, most companies don't even use those fields. They're left blank on a pretty regular basis. And if you leave those blank, what are you using to be able to measure if they fulfilled their commitment? If you're not even getting commitments from your suppliers as to when they're going to give you the goods, how can you plan effectively as to when you're going to be able to have those goods to be able to share, to produce your products to share with your customers? And so being able to measure those things, measure your supplier performance, and really find the suppliers that are performing well and do repeat business with them rather than just letting anybody go create a new supplier and leveraging that. So let's talk about what do we do about this. So we understand the risks. What are the solutions? There's always going to have to be some element of a manual review, and that's on the bottom left there, where you're going to someone's going to need to eyeball your suppliers to figure out which ones stay, which ones go. But that's just a strategy. It's certainly not the only strategy that should be employed. Next step is access. You've got to make sure only the right people have access in your environment, and that's what this second bucket is really getting smart about that. Third is around measuring vendor performance. You've got to be able to know how are my vendors performing and which one should I use. And the last is getting smart with the data analytics. The whole concept here is if you've got a smaller set of suppliers and you use them on a regular basis, that's going to give you the opportunity to drive deep discounts. Stephen talked about that. It's going to allow you to make sure and measure vendor performance as well. And so those are the kinds of things that you're going to want to think about. So some of the strategies and solutions we've helped clients look at, using various technologies. Who's got access in my Supplier Master? You're going to want to look at that. In this case, looking at supplier use. What suppliers were only used one time during the year, and how were they performing? Did they have backlog, back orders, all those kinds of things? Some other visualizations, some of my favorite ones, we look at which users created invoices and created or modified the supplier or the supplier bank for those particular invoices. And then lastly around, maybe you find that happen. Let's start looking at the bank accounts that were used in the payments. And so if you find that payments went out the door and they share that same bank account as one of my employees, that's going to be an instant red flag. And so lots of different solutions, lots of different ways of looking at this. But if you're not getting smart with your data, you're going to be missing out on risk and opportunities that might be out there. So with that, let's go to our fifth and final polling question. Steve.
Thanks, John. All right, so the last polling question. When was the last time you performed a detailed assessment of your current suppliers? A, 5+ years ago. B, within the last 1 to 5 years. C, within the last year. Or D, never. So John, well, folks answer that question. What do you feel about this? Do you feel that clients should spend more time evaluating their suppliers on a more frequent basis?
Yeah, absolutely. A lot of clients get discouraged because they do some sort of a cleanup exercise, and they're going through and they dump it to Excel and they go through this huge list of suppliers, and it's painful. It takes months or years. But because they don't solve the problem, they don't solve access, they don't have monitoring, that problem just keeps coming up over and over again. And so it's about getting smart with how you do those assessments rather than just doing them.
Great. Looks like we fell back. Let me get back onto the polling question. Apologize.
No, that's no worries. That was just me messing with you. Sorry about that.
I figured as much.
Yeah, for sure.
All right. Let's see if we can get the results. All right. So it looks like the majority have done it in the last 1 to 5 years. So great, appreciate that. All right, let's recap. Coming up on the hour. All right, so what have we learned today? Well, we've provided a deeper dive around 4 key risk areas. That includes cash leakage, specifically around duplicate spend, matching setup complexities. Hopefully you can appreciate that. Invoice processing considerations that can impact bottom line performance and financial accuracy. Supplier Master management considerations that, if ignored, can have a negative impact or implications on the business. So the world is changing really at an incredible pace. The regulatory environment that we're working in is becoming more complex every day. Government regulations are ever increasing. I think everyone can appreciate that. Every day we're creating and storing more information in a digital format than has been stored for most of our history on paper. Innovation is really no longer an option. It impacts every industry and every discipline. Data integration, GRC, visualization technology are all helping to change the way we view and manage our business, specifically help us manage enterprise risk. And then finally, audit regulatory boards are expecting auditors to leverage data mining techniques to audit through the ERP systems to opine more confidently. Increased scrutiny should be expected. In fact, we're seeing quite a few cases where that scrutiny has already occurred, and companies are scrambling to address the issue, and that includes leveraging technology to do so, as well as a significant amount of remediation. So as a result of it's really becoming an imperative that our clients understand ERP risks better and vulnerabilities better at a much deeper level than ever before. And given the complexity and size of these ERP systems, technology solutions are moving from a nice to have to a need to have. So, as we conclude, I think we should all ask ourselves, where do we stand in relation to identifying risk and establishing an effective control environment to help mitigate that risk? Are we capable of effectively translating the massive amount of data in our ERP systems into meaningful information in order to gain insights and take the appropriate actions to mitigate risk for our businesses? So, with that, unfortunately, we've gotten quite a few questions. Given the time, it's likely that we won't be able to cover those. So I apologize for that, but rest assured we will be reaching out via email to answer your questions. Also, everyone should expect to receive an email that will give you a link to replay this webcast if you would like, and also share with you future webcasts in the series. Please, everyone, don't forget to complete the survey at the completion of this webcast and download your certificate. On behalf of Steve and John and myself, I want to thank everyone for joining us today and look forward to visiting with you on the next webcast. Thanks so much.